Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Doing well, thank you, sir. Enjoying another
That's right.
podcast Friday here in beautiful Lansing.
It's a sunny Friday morning.
Yeah, we got a little bit more rain, which is exactly what we didn't need
Oh,
after the 3 or 4 inches or whatever we got the other day. But on the positive side, Dave, my lawn has never been so green this
uh,
far into July
well,
since I
my
can
my weeds
remember.
are doing
So
well, but it's a bright, sunny, nice day up here. So you're in the wrong part of the state, my friend.
it's coming. So
All
today's
right.
topic, the quarter just ended here, the end of June, and so we are back in action with our quarterly market review, figuring out what happened in
Yeah.
Q2 and what we can look forward to in Q3.
Yeah. Kind of take our reading of where things stand and avoid predictions, but here we go.
Let's do it.
It's been a pretty astoundingly good year in the overall market so far at the midway point.
Yeah, it's funny that you mentioned that because it seems like there's this disconnect between how people feel about the economy and the markets and what's actually happening. Although over the 4th of July, I saw enough people shooting off fireworks that they must be feeling pretty decent at least to be
Yeah,
blowing up that
yeah.
kind of money.
Lots of discretionary income going up in smoke,
Yeah,
literally
exactly.
smoke and noise. So yeah, and
Uh,
boat fuel. So so yeah, the market's pretty strong. For the quarter, the all cap index, the Russell all cap index, was up 3.2%, and is up 13 and a half for the year.
mhm,
The S&P 500 up about 4.3% for the year. Um,
mhm.
the most astounding thing about this to me is, of that 4.3%, 4.1% of that came from tech stocks,
Yeah, crazy, right?
in a handful of those. And if we look at the large cap growth index, which would encompass, the tech stocks, it was up 8.3% overall for the quarter, and is up over 20% for the year. So we're seeing a pretty strong market overall
Mhm.
in stocks, um, but continues to be driven by a very, very small subset of stocks, which creates some interesting conundrums, right?
Yeah.
Yeah, the market's doing well, but if you're diversified, you don't look quite as good as that. But we know that
Right.
we need to be diversified to control risk,
Mhm.
and it. And then it's also the question of, okay, what happens when those couple of stocks lose steam? Do other stocks do well, or does the market as a whole take a hit? How's this going to play out?
It's a very interesting time for a diversified portfolio. Lots of thoughts and feelings going on about that. Like, when you see that kind of growth come from a small sector, the
Hmm.
temptation is, well, let's just, chase those returns. But the reality is, most of the time,
Yeah,
that's you're too
yeah,
late.
yeah.
So,
Right, right. You
you
needed to
know,
be there before the move. So, and there's
mhm,
no telling when those moves happen. We'll come back to that a little bit here at the end. Um, the bond side of the equation held its own for the quarter.
mhm,
The aggregate bond index was up just slightly, about a tenth of a
mhm,
percent. Um, and if we look across the spectrum of bonds, really only intermediate term municipal bonds were negative for the quarter.
yeah, hmm,
So that's always good. And at the same time, those bonds are still producing income for us too. So
right,
we see the
yep,
prices hang in there, and we collect our interest payments, and it's a good thing.
yeah, for sure,
Um,
yep,
Also, too, in if we look at the yield curve, there's been concern since mid 2022 that the yield curve was inverted, and that's not a good sign for the economy usually.
hmm,
And it's become a little bit more normal this
yeah.
quarter, with long term rates rising a little faster than short term rates, and vice versa.
Yeah,
So
definitely
that's a good thing.
trending in the right direction. So always a good sign, right?
Yeah, at least not worsening.
Yes.
Um, International stocks, kind of a tale of two different types of international stocks here for the quarter. Developed market stocks, so European mostly, negative for the quarter, about a 0.5%.
Hmm.
Um, and we have to note that part of that is because the dollar has been so strong.
Hmm.
And so when you own assets denominated in other currencies like euros, and your currency is strong, when we translate those stock prices back into dollar returns, it doesn't look as good.
Right. Yeah. Another one of those
So
conundrums, right?
right,
Talking
right.
about
I
a
mean,
diversified
in
portfolio.
general, yeah, yeah. And but on the other hand, emerging markets, even with currencies involved, were positive 5% for the quarter.
Yeah. Yep.
So finally seeing a little improvement there with emerging markets kind of been a drag for a while. Um, so that's kind of where we sit overall. A pretty positive year so far. Um, but we don't want to predict, and we don't like to draw short-term conclusions from that. So where are we sitting right now? If we look at the balanced equation of what's on the good side of the ledger and what are we worried about?
That's right. So, as far as positive signals and kind of where we're starting at, speaking of, we talked a little bit about the economy and kind of the disconnect between people feeling like the economy isn't doing well. And when you
Hmm.
look at it from the basis of unemployment has been under 4% for 30 consecutive months, which
Yeah.
seems to me like a very long time. And it actually increased to
Yes.
4.1% in June, so under that or over that 4%, but basically right in that same level. So not a big change as far as unemployment goes.
Right. And still a very solid number, and not indicating a problem in the economy, although there is, some talk of under the surface of the jobs reports, it's starting to show some weakness, which is to be expected with interest rates
Yeah.
having risen as much as they did. So maybe we're finally getting some signs in the labor market that the economy is slowing down, which also helps keep inflation under control. So it's about balance, right?
Yeah, it's kind of backwards thinking right now, right? Like every time you see the unemployment rate tick up, the market celebrates because maybe things are getting starting to get
Right,
worse, which means that the Fed will loosen their monetary policy, right, and ease up on interest rates
right,
or even decrease them.
right.
So it's kind of
Still,
counterintuitive to like where we're at, but if you understand like the basics of where we're at and what some of these numbers mean, the
yep,
market's kind of celebrating a little bit the unemployment. It's actually that unemployment's
yeah.
actually going up. So
And
strange times
for
we
the
live in,
quarter
Dave.
growth, yeah. Well, always we always live in interesting times, and growth, gross domestic product numbers continue to be strong. We're still seeing the economy, in growing over the last quarter.
Hmm.
And May's inflation report was another step in the right direction in the inflation fight, starting to see, some better numbers there. Still seeing some inflation in core good. I'm sorry, in shelter, particularly. Housing costs are still growing. Our auto insurance costs are definitely still on the rise.
Yeah.
But core goods and some of the necessities have actually come down a little bit, and um, seeing a little bit of relief on the inflation side.
I thought that was super interesting. I'll have to make sure that we throw this chart up in the show notes. But just like looking at the breakdown of what contributes to that CPI number and seeing like where the vast majority of that lies and kind of how that's changed
Yeah,
over time, I found fascinating. And then I
Yeah, that's a good.
believe that the June numbers just came out. Was it yesterday or Wednesday? And a little bit, another
Hmm.
good report headed in the right direction. So,
Yeah.
all good signs
Yeah.
when it comes to inflation. But, you know, just because it moves in one direction doesn't mean it can't move in the other direction. So,
Right. 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 And the fourth positive signal here on our list is that even with the top 10 stocks in the S&P 500, you know, driving the driving the indexes higher on their own, they're still delivering on the earnings, right?
right. Hmm.
So, we're seeing, I guess, there's always the old cliche in the markets, right? You buy the rumor and sell the news, and um, those stocks have been driven up by expectations of their earnings being stellar, and there's always that fear, at least for me, being the contrarian worrywart,
Right.
that, oh gosh, they're never going to be able to deliver on that. Well, so far so good. They've been holding their own. So
Yeah, I think the
um,
one that's,
remains,
obviously when we talk about earnings and those companies that are driving that, I think the one that's the most surprising to me is Nvidia just keeps,
hmm
their earnings numbers just keep, you're just
yeah.
waiting for that other shoe to fall and it just hasn't happened, right?
Yeah, well, you hear the talking heads on the finance shows say things like that stock's priced for perfection, right?
Right.
Meaning
Hmm.
that everybody's expecting the news is only going to be good, and that usually is a harbinger of disappointment, right?
Hmm.
And
Hmm.
we haven't been disappointed yet,
Yeah.
so that's good. That's good. Um, all right, so those are our positive signals. What about the other side of the equation?
Yeah, I guess suppose if we're gonna do the good, we gotta put the bad with it,
Got to
right?
have the bad. Yep.
So
Nature of the
we've
game.
talked about this a little bit already as far as concerns, and that is, is the consumer starting to crack? The
Yeah.
consumer, you and I, Dave, drive 2/3 of GDP here in the United States.
Yeah.
And we're starting to see some elevated delinquencies on credit cards and auto loans, signs that
Hmm.
maybe our spending isn't going to keep up with kind of what we're bringing in, and that can, or
Right.
in, unemployment, things like that. So that's definitely
Right.
something
If
that
if
bears
you
watching.
if you buy into the idea that a lot of the inflation of 2022 was caused by the fact that consumers had extra money on hand from government programs and relief coming out of COVID, not being able to spend money during COVID, um, it's beginning to look like we've used up that extra.
Yeah, exactly.
Yeah. So, um, it's just a question of whether that means things drop precipitously or do they continue to slow down and the Fed's able to lower interest rates and re-stimulate the economy in a good way and kind of maintain that balance.
Yeah, well, it definitely bears watching. We've seen some good with consumers as far as real wages and things like that, but also, the good times can't roll
Yeah,
on forever. So there's got to be some discipline and pushback on that. So it'll be interesting to
right,
see how this plays out.
right. And inflation is still above the Fed's 2% long-term target.
Right.
So, as our second point on the reasons for concern, we're not there yet. They've made a lot of progress and they haven't broken anything yet, but we're not where they want us to be. So hold on, we're not done yet.
Yeah, and much like we've seen in the past couple of years, it's not more than likely not going to be a smooth path, right? There's going to be some bumps in the road, and
Right.
we should expect that all of a sudden the Fed's not just going to wave the white flag and we're going to be at 2%, right? Like
Yeah.
it's not. It's going to be a process still, more than likely.
Right. Right. And then there's always the fear. Okay, how do they level it back off at 2%? Do they? Do they overdo it and tip us into recession and de-inflate, disinflation, um, or or are they able to steady things off with deflation versus inflation? Sorry about that, and level us off with 2% inflation without going too slow.
Right. Yeah. It's
Yeah.
you know, it's a science, but it's not a perfect science, right? Like they have an
Hmm.
idea of what they would like to do, but it very rarely follows exactly what they want. What they want, and it's a matter of having very sensitive breaks, and
Right.
sometimes you overcorrect, and then that causes problems. And so it'll be interesting to see kind of how they wade through where we're at right now and getting us to the
Yeah.
point where they want, where they feel comfortable going the other direction, right?
Right. Right. So, and then back to the idea of the leadership in the markets being very concentrated. The top 10 stocks in the S&P 500 is where the vast majority of that return has come from. We'd love to see that rally broaden out. And beginning of the second quarter, we thought we were starting to see that. We thought we were
Mm-hmm.
starting to see the average stock do better. And instead, it kind of reverted back here over the last 6 weeks or so, where we've seen the leadership go back to those big stocks, big tech companies.
Yeah, I mean, it's not the worst problem in the world to have because the markets are still going up. But, in a perfect world, we'd like that to be more of a broad rally where lots of different sectors are doing well, not just tech, which is kind of where we're at right now, right?
Right. Right. So if we look at some of the numbers from the last quarter, um, 5.25 to 5.5 was the Fed's policy rate that they set in July of 2023 as they worked to tame inflation. It was the highest
Mm-hmm.
level since 2001. The Fed has paused there, and we're still waiting. So it's been a year here waiting for the
Wow.
pivot to
Yeah.
lower rates. I didn't
And I don't
realize it had been a
think,
year.
yeah, I didn't either. I don't think anybody expected us to be here for a full
Right.
year, right?
Right. No, nobody did. And that's kind of the next point on this list is that now the everybody expects one interest rate cut. That's what's priced. I shouldn't say everyone. That's what's priced into the market. Is now the expectation for 2024, where back last first quarter of the year, everybody was pricing in 6 to 7 cuts,
Yeah.
dramatically different.
Yep.
And
I
the
mean,
the
even last
expectation at the
quarter, we're,
beginning of Q2 was 3.
yeah,
Sorry.
yeah. So it's changed quite a bit, even this year, as far as what rate cuts we thought we would see and how that would play out.
Yeah. Um, the CPI numbers for May 2024, 3.3, and slightly below the 3.4% April figures. So that's, we're seeing that inflation tick down.
Mm-hmm.
And let's see, 37% is the amount the top 10 stocks in the S&P 500 comprise from a market cap perspective. So the top 10 stocks are more than a third of the overall market. And that's the highest that's been since the mid 90s.
Yeah, very
So,
interesting kind of how
where
that plays out and concentrations and the problems that arise from that, right? Just going back to the whole diversification thing, right? Like if you're only buying an S&P 500 index fund, all of a sudden what you thought was diversified is becoming less and less diversified, right?
yeah, yeah. And at some point that rotation starts. It just has to. It's just a question of when, and we never will know. Um, there's if we look at the uh, the history, the question: should we just be in those 7 stocks, right? Should we just buy the Magnificent Seven? Should we just
Yep.
buy the biggest tech stocks out there. When we look at how that kind of thinking has played out over time, you know, if you look back, the average for history of repeating. So if we look out a few years at how those leaders have done in any given
Mm-hmm.
time, usually that leadership has changed.
Mm-hmm.
So at some point we see that rotation into other names. And if you look back at the top 10 holdings in the S&P 500 5 years ago, 3 of those were the same as what we have now. So Johnson and Johnson, JP Morgan, ExxonMobil are no longer, part of that top 10. They've been replaced by Nvidia, Eli Lilly, Broadcom.
Mm-hmm.
So, we don't know who that next rotation is going to be to.
Right.
So, um, lost my thread. You still there?
I'm still here. Are we going back to that? I think there's one other number on here. I don't know if you wanted to do that.
Yeah,
I'll send him a note.
Hammond's gonna have to bail us out on this one. Oh, 15.3% was the S&P 500 return year to date through June 30th. And if you take Nvidia out of that, the return would have been around 11%. So about over 4% of the S&P 500 return was all driven by Nvidia.
Crazy.
Yeah, it's nuts. It's nuts. So, um, interesting stuff in the Wall Street Journal this week about like companies that have invested heavily in AI are now anxious to see how that's going to pay off for them. So
Right.
we've seen the tech giants that are driving AI's growth. They're getting paid on the promise of AI, and now these companies, every day, you know, um, corporations that have invested in the idea that AI is now going to improve their processes are now waiting to see what the payoff's going to be. And
Yeah.
that'll be interesting. That'll be really interesting. We've talked about this in the past, but when we look back at the late 90s and the internet craze, yes, there were individual companies that rode that wave up as they developed websites and e-commerce, and a lot of them then wrote it back down in 2001, 2002. But if you look back at what it really meant for the overall economy, it was the companies we use every day that we don't necessarily associate or didn't associate at that point at all with the internet, that have really benefited from e-commerce and just the whole growth of that side of consumerism.
Yeah, it'll be interesting because, I think everybody believes that AI will change things, but it's not, just because just because people believe doesn't mean it comes true, right?
Right, right. Well, and we've had those conversations, in our firm. Like, okay, this sounds great. How do we use it? What can it mean
Right.
for us? And we don't know yet. We don't know
Right.
yet. I'm sure 5 years from now there will be some aspects of AI that are new to us now that will be, just part of our everyday routine at that point.
Right.
It's hard to say what
Yeah.
they'll be, and we're not there yet.
That's the problem, right?
Right.
Especially when
Right.
you're, trying to speculate on which one of those companies that are, getting this boost because of AI are going to be the ones that actually make that play out long term, right?
Right. Right.
You
Absolutely.
know.
So, we'll just have to wait and see. It'll be interesting. It will be
Yes,
interesting.
it will. That's why we do these. That's why we follow the market, because if nothing else, it is interesting, right? A
Absolutely.
great social experiment, if you will. So, to our listeners, if you have questions about this or any other topic, please feel free to email us at info@srbadvisors.com. Dave, as always, it has been a pleasure, my friend.
It's fun, Nick. I will talk to you later.
This is a Zedia Media production.